Should you invest in life insurance as a part of your retirement plan? And I don't mean buy life insurance as an estate planning tool. I mean, should you invest in life insurance as a vehicle to produce future income? It may surprise you when I say maybe. I have personally incorporated life insurance as an investment and retirement vehicle in clients' financial plans, and if used correctly, it can be a valuable tool. Let's start off with the main why. The most acknowledged benefit to building a retirement nest egg in an insurance policy is the potential for tax-free growth and distribution, something I have advocated very strongly for. You fund a life insurance policy with after-tax dollars. Certain insurance products have the potential to be invested and grow, and then you can distribute some of that cash value to yourself in the future. Those payments from the insurance policy may be tax-free if you follow all of the rules. In order to qualify for this preferential tax treatment, the policy must maintain its status as a life insurance policy. Now, I'm really simplifying tax law here, guys, but in the most simplistic terms, you must maintain a certain window, if you will, between the value of the cash buildup in the contract and the value of the death benefit. Essentially, it must maintain the form and function of an actual life insurance policy that pays a benefit upon your death. Cash value in a life insurance contract is like equity in your home. When you sell your house, you don't get the equity you built up and the purchase price. But while living in your home, you can tap into the equity if you need it. Financial advisors using life insurance as a retirement savings tool are purposefully building up the cash value or equity in the policy. You do so by paying higher premiums than necessary and generating investment return or interest on the underlying cash value. For example, you could potentially elect for your cash value's performance to match the S&P 500. Over time, your cash value should grow and grow. At some point in the future, you actually start taking some of that cash value out in installment payments. Technically, those payments come to you in the form of a loan. And again, if you followed all of the rules, that could potentially be tax-free income. Of course, there is a catch. It is life insurance, which means a portion of your annual contributions will be used to offset cost of life insurance. This is referred to as the mortality and expense risk, which means, generally speaking, this strategy is more expensive than other after-tax savings options like a Roth 401k. When I have a client interested in building a nest egg with after-tax dollars, I look at the following options first. Number one, is the client already maxing out their Roth 401k deferral? Number two, do they have access to after-tax deferrals in their 401k that can be immediately converted to Roth? And three, finally, should they consider converting other pre-tax savings like an IRA to a Roth first? Once all of the other avenues for after-tax savings have been utilized, then I evaluate their insurability. Are they young? Do they have any major medical concerns that could increase the cost of insurance? Do they even have a need for a life insurance benefit? And of course, you should consider what is their tax rate today, what will it be in the future, and how long do they have before they intend to start taking distributions. Generally speaking, this strategy is more appropriate for younger, healthy, high-income families that want to save above and beyond the traditional 401k limits. To be sure, this is a complicated strategy. Unlike funding a retirement plan, insurance quotes are based on a stated premium. Investors need to be aware of the potential risk if they are unable to make a premium payment. A lapsed or failing insurance policy is typically not a good thing. Be sure to speak with a certified financial planner before deciding to invest in insurance and understand how the tool fits into your overall financial plan. That's it for this week. This is Jeannie, the 401k lady.